Given that we cut rates off cycle, and given there has been no significant new development on inflation and the fiscal front since then, we have maintained status quo on interest rates. However, we have taken actions in a number of other directions, and the details are in the document we have handed out. I'd be happy to address any of the questions there. Many of these are intended to further the growth process, and some are intended to enhance stability of the system. In terms of guidance going forward, the guidance remains what it was when we cut rates, that further action will be in the direction that was initiated, and that it will depend on developments, in particular on developments on the fiscal front, as well as a continuation of the disinflationary process. So our further actions will be driven by the data. Let me stop there and ask Gurjit Patel if he has any anything to add.
No, not much. One thing that I would like to bring forth is that we are at the midst of an age of competitive depreciation and beggar thy neighbor monetary policies. As you know, the Swiss National Bank abandoned its peg. Singapore eased its monetary policy on January 28th, and it fell to its lowest level since 2010. Central banks have intervened heavily in the bond markets, bringing yields down to historic lows. This reminds one of an African saying that when elephants fight, the grass suffers. And the economists said that the ECB and Bank of Japan are printing money and devaluing their currencies, while the US economy is growing strongly. Anyone who stands in the middle risks getting crushed. I think this forms an important backdrop of our macroeconomic management as we go forward and face these quite unusual challenges. Thank you.
Okay, question time. Yes, Lata.
Morning, Governor. You haven't given any guidance at all. Sorry, Lata from CNBC TV 18. You haven't given any guidance at all. If you can give us some idea of how you see the CPI trajectory with the old base itself. If it is only 6% as your forecast for Jan 16th now indicates, what will be the real rate that you will be comfortable with?
I've talked about all these, so I'm not sure what new guidance you want from me. I will reiterate that we are looking for developments on both the disinflationary process. We would like to see it continue. And of course, on the fiscal front, we have a budget coming up. So those are important developments that we will pay attention to. Now, I'm not going to give you a number that I'm looking for in each of these things. These are more complicated than particular numbers. They're a whole package. We would like the forces that are in play, including the transmission of lower oil prices. Of course, oil prices went up in recent days, but our hope is that the modal estimate is these things will stay low for the coming year. That as these lower prices feed into prices more generally, that will help the disinflationary process. Also, we've had a relatively stable exchange rate so far. That will help also to some extent. And there has been, some actions on food management. Of course, this is the season when vegetable prices start picking up, and we want to see how those will play out. But there is no single item that we're waiting for, but we need more data than we had on 15th of January. And we haven't had significant data since then. So until we get more data, I think we're on pause.
No, I understand until you get data, but if you could reiterate what kind of a difference you want to see between inflation and policy rates. Do you want to see a 2% difference? Do you want to see a 1.5%?
You're looking for what we think is a reasonable level of the real rate. I've said before that we think that between 1.5% to 2% is a reasonable real rate given where we are in the business cycle. Now, of course, different people have different views. You had a panel discussion with Dr. Rangarajan where he would like to see it closer to 3. There are some people who would like to see it closer to 1. There are others who mix and match and add in various risk premia and claim that the policy rate is now way into real territory. So we have to be a little careful. What we would like is the real risk-free policy rate to be about 1.5% to 2%.
You'll veer towards 1.5 or 2 because you've always been giving that.
We'll go to the next question.
That gives me sufficient degrees of freedom.
Okay, next question from Saloni.
Good morning, Governor. Very happy birthday, first of all. Sir, to begin with, I would like to know your sense on the new GDP series. Now, what one camp is saying is that this reduces the room for monetary easing, while the other camp, and I was reading some articles this morning, says that this gives RBI the excuse to tighten monetary easing. What's your sense on the GDP series, considering the fact that the FY14 target has jumped substantially upwards?
We do need to spend more time understanding the GDP numbers, and we will be watching February 9th releases with great care and delving deeply into what we see there. At this point, it's premature to take a strong view based on these GDP numbers. Most of the data that we have seen for 2013-14, except inflation, which was very strong, give us a sense that there was slack in the economy. I think the chief economic advisor has pointed to the fact that imports, non-oil imports were coming down substantially, but there are other factors, including, for example, auto production, which is a fairly clean number, which were coming down over this period. So we find it hard to see the economy as rollicking in 2013-14. However, we must understand better why those numbers kick out, and it could be that it's not manufacturing, but services which was stronger during that time. One of the interesting factoids that you see is that India is moving more towards consumption of services away from consumption of manufacturing. So it could play a bigger part in consumption. But I don't want to say anything about the numbers till we understand them better. Let me say that our view will be formed only in part by numbers. It will be also other indicators that we look at on the strength of the economy.
Governor, the second question is on something that you mentioned in this policy as well, and you have mentioned time and again on rate transmission. You've given two separate examples. One, the recent rate cut that we saw on 15 January, and prior to that as well, there has been hardly any rate transmission. Post 15 January, only two banks went ahead and cut their or revised their base rates. Is there a nudge required from the Reserve Bank of India when it comes on, with regard to rate transmission?
See, the Reserve Bank is not the owner, is not in any way involved in the day-to-day running of the banks. That's a decision that the owners and management have to take. So we cannot nudge them. We can only comment on the fact that despite a fall in long-term interest rates, a substantial fall, treasury rates have come down a significant amount over the last year and a half. And corporate bond rates have also come down substantially, that bank lending rates have remained more or less flat over this period. Now, you see some movement on new loans made by banks. There's been some adjustment in rates, but in general, base rates haven't changed. Of course, when you talk to banks, they're very happy that we cut rates. At some point, my guess is transmission has to take place. So we have to look at that also.
Vijay?
Governor, a couple of questions. The
Question,
first one,
please, one question.
Yeah, okay. The first one, the simple question is, You just mentioned that until there are further triggers, you're effectively in a pause again. Having seen the experiences of going for the baby steps approach in the past, as an institution, would you at this point be looking at more significant measures and then pauses rather than going for a long-winded baby steps approach?
Look, we've paused for 15 days. Come on. Monetary policy is a long-term process. So don't hold me every 15 days to something new. What we have said is we're waiting for data. We have a budget coming up. That's a significant change in the fiscal space. It is going to be an important change. We've got new GDP numbers coming on February 9th, which will reflect a whole new view of what's happening in the economy. We've got inflation numbers coming. I mean, this is all data that we need to watch for. Now, if I cut interest rates today, again, 2 weeks from now, you'll be asking me, when are you cutting rates again? So let the monetary policy process follow its due course. And monetary policy, remember, works with long and variable lags. In India, approximately 3 quarters. So we cut interest rates, it makes news for you, but it doesn't do anything for the economy for 3 quarters. So what we need to do is take into account the whole view, knowing that we are steering a ship which moves fairly slowly. So we need to work with that, and we need to take all the information we need. I said again and again, I'm not for doing one thing and then reversing that. So we will do it as and when the information comes. There are important pieces of information we're waiting for. As soon as that comes, we'll be in a better position to decide.
So can I just the CPI is also being rebased. So we don't know where that is moving. And it wouldn't be terribly responsible for us to take that as not an important component into what this thing is going to look like if you see what has happened to the GDP numbers. In terms of the forward guidance, I think that what was said in December and then in January, that which the governor has reiterated several times, is that once we have embarked on a change in the direction, we will stay put in that direction. I think that's adequate forward guidance. And the fact of the matter is, since January 15th, we have had no substantial data point on practically any macroeconomic variable.
Governor, just to clarify on, you spoke about stable interest FX rate. How much of that is a consideration in when you all are intervening also, because it has also been an issue that there has been a lot of talk about RBI intervening. Is there a sense that there is excess appreciation also?
I think it's too early to say that the exchange rate has played a big part in the export numbers. In fact, if you look at export volumes, they're still up for the non-oil, non-gold, non-jewelry part. And I think at present it would be wrong to say that we have become grossly uncompetitive. And as you know, there are different estimates of what the appropriate exchange rate is. If we just add inflation, we get the sense that our real effective exchange rate has appreciated quite a bit. If we couple that with productivity growth over time, then the appreciation is significantly more moderated. But that said, as Deputy Governor Dr. Urjit Patel started off saying, we have to be a little careful in this world. As I've said in past meetings, people keep looking at the exchange rate vis-a-vis the dollar and say our currency is weak, but we have strengthened versus virtually every other currency. So it is something that we have to be watchful for. We do not intervene to try and target a particular level for the exchange rate. Where we do intervene is to reduce volatility, and we have intervened in both directions in recent months and weeks. So we both buy and we sell. So it is not in any way an attempt to go one directional. I think we're perfectly comfortable with where the rupee is, but it is a risk that we have to keep in mind going forward with the massive amounts of quantitative easing that are going on in the rest of the world, that there are possible dangers of us becoming uncompetitive on that dimension.
Neha?
Yeah, Governor, happy birthday. Neha from Reuters here. My actually two tiny questions, which I hope qualify as one. Okay, one is you've omitted the inter-meeting move which you mentioned last time. So is that saying that you won't do that again? And second, you've allowed foreign investors to reinvest coupons in government bonds. I mean, just wanted to get a sense, why not just open up the limits for longer-term investors? Wouldn't that just been safer instead of for the short term?
The two questions. No, we said it once. Now, we don't need to reiterate the possibility that inter-meeting moves are always on the table. They're never taken off. They've always been on the table. So I don't want to keep emphasizing. The last time we emphasized because we had done actions during meetings, and we'll try as far as possible to stick to meetings. But one reason we did it last time was because we had said in public that we wouldn't wait. I think the phrase was a minute longer or an hour longer, a moment longer than when the data suggested we could start cutting rates. And given that public statement, we felt that as soon as the data suggested, and there was no more data awaited, we would cut rates. So remember, all the inflation data had come in, including WPI inflation, and we cut rates on the 15th. Now, there's been no data since then, right? So we will await more data, including the important data on CPI rebasing that Urjit talked about, as well as fiscal developments. And after that, we make judgments about what next happens. But there's no conscious desire to omit that part of the language. The second question was on reinvestment of interest. Now, we do want to manage the country's balance sheet to make sure, as I've said before, that we have a bulletproof balance sheet when the inevitable interest rate rises come. Now, we have taken two actions in that regard this time. One is recognizing that we would not like to be seen as against foreign investors, and given that we want to expand limits on a regular basis, given the interest in India today, if we just expand the FPI limit in government securities by let's say $5 or $10 billion, it will be taken up in a couple of weeks, and we'll still get people wanting us to open more. We thought a more streamlined way of doing it would be to allow reinvestment of interest, which is a more regular feature and which will allow some room for our patient investors who have stayed with us and have taken the coupon to reinvest their coupons. So that was the reason for the government securities. We have seen a considerable amount of investment at the short end in corporate securities. And in the same way as we did not, when we limited reinvestment in government securities below 3 years, we did not do the same thing for corporates because we wanted to develop the corporate market also. There has been some of that, but again, there's too much sitting at the short end. And we would like to nudge people into the longer end. So we've said when you reinvest in 3 years and above securities. Hopefully, that will alleviate some of the pressure that could be building up in the corporate debt market. And this is a prudential measure again. Let me emphasize, we are open to foreign investors. We welcome them, which is one reason the FDI action we have taken today, that is these put-call options that were embedded in various investments, we've said we're not against them. We just want to make sure it's not hidden debt. So if you have a put option, but the put option is at a price which is lower than what you invested, so you don't get a guaranteed debt return, we're okay with that. So we're trying to make it easier for foreign direct investment. There are other features that were earlier not favored, which we will open up as we look into this and come out with a detailed paper. But the idea is to make it easier for foreign direct investment, even with a variety of contractual features that would allow these investors to put money in.
Amol?
Hi, sir. Amol Dete from The Business. I would like to know, like you said, that transmission has to take place. In October also you mentioned that early next year you will cut the rate, which you already did 15 days back. But transmission has not taken place. I want to know what is RBI's view. What could be the reason कि बैंक rate कम नहीं कर रहे हैं? क्या वो wait करना चाहते थे इस policy के लिए? Because you have seen now in the policy also you have mentioned that there is a revival in the industry. Whatever the government has taken the initiatives, but still the banks have not transmitted the rates.
So a couple of banks have in fact cut their base rate. Some banks are, I presume, worried about the fact that if they cut their base rate, it impinges all borrowers, not just the new ones. Given how weak credit growth for the banks has been, and overall financing has been quite strong because they've gone out, large corporations are going outside the banks. I think at banks at some point will have to start lending again. And to get that lending, they will have to be more competitive, which means they will have to cut their base rate. Now, we did revise our directions on how they calculate base rate to make it a little more transparent. But I'm hopeful that it's a matter of time before banks judge that they should pass it on. Many have been relatively quick to cut their deposit rates, but not so quick to cut their lending rates. And I presume some are hoping that they can get the spread for a little more time to repair bank balance sheets. Eventually, competition, Sparda? Sparda is what matters.
But sir, since you also reduced the SLR now, do you think that perhaps it's the right time looking at the banks?
I don't know right time. It's their management which has to decide what the right time is. I think it's the pressure of competition which eventually forces them to pass through these cuts. So let us wait and see. It's not regulatory intervention, it's competition.
Gayatri?
One is, how do you see the disintermediation that is going on in terms of corporate opting for CPs affecting transmission? And then now you have announced a major kind of liquidity measure. You're replacing export credit refinance system. So how is it going to make a difference in terms of impact to the economy or transmission? That is one. And the other on NPAs.
That's the third question.
That's on restructuring. Okay. That will you allow acquisition financing in case of chronic NPAs and willful defaulters?
Okay. On the disintermediation, I think that's part of the competition, that banks are now facing competition from the money markets.
Right.
And a number of corporations are going directly to issue commercial paper. And if banks don't react to the lower, number of banks are saying I can borrow less than the base rate by going to the markets.
Yeah.
At some point the banks have to react. And so that will push banks to reduce their lending rates. So that's why this will take, I think over time the transmission will take place, simply because there's so much competition.
So do you see this particular factor impacting transmission? Because you said it takes
I think
3-4 quarters.
I think it will help.
Lag, so it will help in reducing or increasing the lag.
The transmission of monetary policy takes time because even though interest rates change, the change in interest rate feeds into investment over time. So it's not the first leg of transmission I've been talking about, but it's the second leg once it's gone into interest rates. Now, we're still waiting for the first leg to take place, that it has to go into bank lending rates. It has already gone in some way into call money rates, because call money rates have come down. We're infusing enough liquidity into the market, and therefore, I think we will see that transmission operate already, because it's reducing the cost for large corporations to borrow from the markets. Banks will have to match that at some point. In your second question about ECR was being used less and less. And we thought, given the Urjit Patel Committee recommendation that we should move away from special windows to a generalized auction-based system, and given that we've been supplying plentiful liquidity through that auction-based system, and it's working quite well, we thought that this was a good time to do away with it entirely and move to the full auction. We've been cutting ECR for some time, this was the last stretch which we did away with it. Now we have a fully modern liquidity framework, and I think this is something that that will help us going forward. The third question was on acquisition financing. We have no problem with acquisition financing. There are no constraints on it. I don't know what
in case of if there are chronic NPAs or if there are willful defaulters, how would?
No, what we have said is in case a plant is not completed and there's a possibility that it was because of the promoter not having enough funds or not having enough management capabilities, that in case there is a new promoter, distinctly new promoter brought in, not part of the same group, but somebody new, then banks could get some more time to complete the project with a new promoter that will put some of these projects which are stuck back on their feet. Now, if there are reasons beyond control, such as the unavailability of inputs and so on, that's a different situation. The other big sort of development on the restructuring is that banks can take equity positions up to the 30% stake. So a couple of banks can gain control if they decide to convert or if there's a convertibility clause. Alternatively, in restructurings, they can embed a convertibility clause, and that will allow them to take control in case the restructuring doesn't pan out as promised. So this will allow a more effective transfer in case there's a need for a change in management. The SEBI and RBI are discussing the details of the conversion, the price at which it will convert, etc. SEBI, of course, is interested in protecting the rights of minority shareholders, and RBI is interested in making sure the banks don't convert at too high a price given the fair value. And so that discussion is coming to some agreement, and we will see in the next few, as I said, within a short while, it happen.
Can we go out and check if there are questions, Shaima?
Sure. Participants connected to the audio call, if you wish to ask a question, please press star and 1 on your touchtone telephone. We have the first question from the line of Kate Brabsher from New York Times. Please go ahead.
Hello, Governor Rajan. I wanted to come back to the question of how you are assessing changes in the fiscal space. As you're looking to the budget, are you mostly interested in what the initial year deficit as a percentage of GDP is likely to be, or are you more interested in what the structural changes are on the longer term in terms of what the deficits are likely to be?
I think both. Look, I think the finance minister, as well as all the ministry officials, have reiterated their desire to stick to the budgetary target for this year. But also, there is a lot of anticipation about the, the fiscal path over the next few years. It's not that we're locked into a specific number or a specific path, but it's the overall package, whether it makes for serious high-quality fiscal consolidation over time that clearly will impact the inflationary forces that we are most worried about. So it's all aspects of the budget that we will be looking at and that are eagerly awaited. I think the government has the intent of producing a solid budget.
Thank you.
Thank you, Shaima. Gabriel.
Hello, Governor. Can you hear me? Yeah. Gabriele Parosini from the Wall Street Journal. You have voiced concern today about the spillover of competitive quantitative easing, which is something that you have been doing for quite some time now. I would like to know if you think that India is now in a better position than it was last year or even in 2013 to cope with this coming new wave of quantitative easing that started in Europe. And also, I would like to know if you think that the markets have already priced in completely the coming tightening cycle of the Federal Reserve.
First, I'm not sure that we know fully the process the Federal Reserve will follow. It will depend to some extent on developments on the dimensions that you talked about. As you know, the Federal Reserve introduced a phrase on the international situation in its statement this time. So I have no doubt that the exports as well as the path of the dollar will play some role in their future deliberations. As far as India's position goes, we have made important strides on at least 3 out of 4 macro variables, and I'm hopeful that the 4th we will also move. The 3 on growth, we never plunged as low as some of our comparator countries. Of course, if we take the new statistics at face value, we're already up to 6.9. I don't want to overemphasize that because we need to understand that, but that is one of the highest growth rates in the world. If we stick with our projection of 5.5, we're still doing pretty well for this year. The second element that has improved considerably is our current account deficit, which we project to be 1.3% this year and perhaps even lower next year because of the lower oil price, so long as it stays low. The third element has been inflation. After all, investors are worried about the value of the rupee. That has come down considerably. The inflation has come down, which is one of the reasons the rupee has remained so stable. The fourth element is the fiscal deficit. We have made some strides there, some important strides, and this is where the budget will be an important factor in establishing the continued confidence that our macro actions are all in the right direction. A secondary aspect which is important to help us is the buildup of reserves. Our reserves are substantially higher, even net of forward positions, which today are positive rather than negative last year. And therefore, I think we are in a much better position. Will we be immune from volatility? And the answer is no. I think everybody is affected by volatility. But after the first wave of volatility, when market participants stop to think, I'm hopeful that we will look much better than perhaps comparative countries.
One last question from Anita.
Sir, power producers have been complaining that once the banks categorize an account as NPA or bad, they do not give any further credit. But in case you see that there's a possibility of that account reviving, would you see any merit in banks considering giving them more money for possible revival in future?
I think we should not attribute stigma to an NPA. And this is a misconception that is both amongst producers as well as lenders. The producers think if their account is labeled NPA, it means they're at fault. It just means that the account is not paying, and there could be very legitimate reasons why it's not paying because of policy inaction, because of complications, legal complications, etc. An account could stop paying, or changes in world prices. So the fact that an account is an NPA is an accounting statement. It's not a statement about blame or reputation, etc. That's number one. Second, even an account which is an NPA, banks can lend to it. And in fact, the new loans, so long as they're being serviced, and there could be a moratorium on those new loans also, that loan is not considered an NPA. Our regulations do not label it an NPA. So projects that are halted because they're NPA can be restarted with new loans from the banks. There is nothing that prohibits that. What is important is the banks make a calculation that these new loans are necessary to restart the project, and the package is going to be NPV positive for the bank because it's already made loans which are in trouble. The project needs to go forward to pay off. Here's a little more to ensure working capital needs are met or the final construction phase is done. That's okay. And that's important actually at this time, that in such situations they take a considered decision. I'm not going to micromanage the decision from here, but I'm going to say if those loans are made, they are perfectly appropriate and they will not be considered NPA. In fact, the rules say until fresh loans into an NPA situation are not necessarily NPAs, so long as they're performing.
First deadline for classification of restructuring accounts into NPAs. That's a request from the bankers.
Well, I have said repeatedly that it's important we clean up bank balance sheets, that we show the balance sheets what they actually contain. That will enhance confidence in the bank balance sheets and enable the banks to raise the much needed fresh capital. In order to build confidence in bank balance sheets, we have to come to an end of forbearance, that we have to put banks on the right track. We've given enormous amounts of new flexibility in trying to put distressed projects back on track. But I don't think the answer is to pretend and extend or extend and pretend. It is to call a spade, do what is needed, including making new loans if necessary to complete the project, but move on beyond that.
Can I squeeze in a question on financial
well,
stability?
thank you very much from our side.
I have to actually catch a plane, so
yes.
thank you very much.
Thank you, sir.